Good evening, everyone. So this class will be on types of liquidity. And like I said, liquidity is basically an inducement. Whenever there is liquidity on any side of the market, price eventually comes to that zone and takes out that liquidity. So the strategy that I use solely focuses on targeting one point of liquidity to the other. So if I take a trade, where I'm expecting to take my profits will be on the next draw on liquidity. You understand? So if I take any trade, my exit will be the nearest draw on liquidity. So that's what I'm going to be taking on this trade. There are different types of liquidity in the market, which I drew out some of them. So there's equal lows, there's equal highs liquidity, there's trend line liquidity, and then in trend line liquidity we have the uptrend uptrend line liquidity, and then a downtrend line liquidity. So, and then there's liquidity that's formed when there's a presence of a long wick in the market, something like this. So, how do you apply this in your strategy? Now, these types of liquidity comes in place when you're looking for take profits or knowing if you should take a trade entry or not. For example, for example, if you let's say for example, market starts selling from a trend line liquidity. This is an uptrend trend line liquidity. And then you take a trade and the market is selling from, let's say here, for example, and you're looking to take your buy from this zone, knowing fully well that this is a trend line liquidity. And whenever there's liquidity present in the market, price 90%, 80% of the time sweeps that entire liquidity zone before eventually reversing to the opposite direction. So if I was looking for buys on this trade, I'll wait for price to actually come out and take out this entire zone of liquidity. I'll wait for price to come out and take out the entire zone here before eventually looking for buys to the upside. You're taking a trade here, you are actually liquidity and you eventually you may get stopped out. That's why on our last trade, some people took a trade on Euro USD last week. People kept getting stopped out. Why? Because they're trying to take a buy on a trend line liquidity that has not yet been swept. So for a trend line liquidity for an uptrend, whenever market is making a series of higher highs and higher lows, that is market being on an uptrend, the down part, the opposite part of it, there's liquidity being accumulated on that side. Market is making a series of higher highs and higher lows. This down part, there's liquidity here, trend line liquidity. And eventually, if markets actually change this structure and starts going to the opposite direction, it's going to clear that entire trend line liquidity before eventually looking for a zone to balance and start reversing. Same as market being on a downtrend. Market is making a series of lower highs and lower lows, lower highs and lower lows. There's liquidity being left at the top side of this market. So eventually, if market does anything like a market structure shift and eventually starts going up, it's going to go up and clear the entire trend line liquidity that's laying up here. So if market is making a series of higher highs and higher lows, that's market being on an uptrend, there's liquidity being built on the sell side of the market. So if market eventually starts selling, your take profit zone should always be to clear the entire trend line liquidity. Same as market being on a downtrend. If market is making a series of lower highs and lower lows, eventually if market finds a support or triggers another block that's going to trigger it to go up, it's going to clear the entire trend line liquidity that was resting above that zone while it was making a series of lower highs and lower lows. Because when market makes lower highs here, lower lows, there's money, liquidity is money being left on the top of this zone. Same as market making a series of lower highs and lower lows, there's money being left under here. This is liquidity, trend line liquidity for the uptrend, trend line liquidity for the downtrend. Same as markets making a series of equal highs or equal lows. For example, most people see double bottom and double top and be like, okay, market is going up. But if the equal low that was made here is like if the double bottom that was made here was an equal low, there's high probability chance that there's liquidity resting below this zone. So if market eventually comes here and starts reversing, for example, if market eventually comes here and starts selling, for example, your take profit zone should be the next draw on liquidity, which is this equal lows liquidity. Same as market making an equal highs liquidity. If market makes an equal high here, if market makes an equal high right here, that's this, there's liquidity resting above these zones. So if eventually market starts reversing, your take profit should target the nearest draw on liquidity, which is this equal highs liquidity. Now, how do you identify which one it is? For each time market triggers an entry, there's a particular behavior that it follows while approaching that particular entry. If you are looking for sales, for example, and let's say this is your sell entry here. Before market will eventually get to that your sell entry, there's going to be a pattern in which market approaches your entry. It can be an uptrend, higher highs and higher lows, higher highs and higher lows, higher highs and higher lows. Eventually triggering this your entry. If it triggers your entry, it will now start selling. And once it starts selling, it's going to clear the entire trend line liquidity. That is where your TP should be. So if, for example, your entry for your sell is here, and the pattern in which markets are approaching, that entry is trend line. If it's an uptrend for sell, your take profit should target clearing the entire trend line liquidity laying there. Same as you looking for buys. If this is your buy entry, and the market is making a series of lower highs and lower lows like this, lower highs and lower lows, lower highs and lower lows, lower highs and lower lows, lower highs and lower, then triggers your entry. Your buy should cover and sweep this entire sell trend line liquidity here. That is how you know when to take profit. So there are different types of liquidity. There's the equal high liquidity, there's the equal lows liquidity, there's the up trend line liquidity, and then down trend line liquidity, and then the long wicks. These are very important, knowing your take profit levels. I'll give a visual example of a market being on of a trend line liquidity actually. So I'll do for one. This is a trade I took today, USD. Understand? So this is my buy entry because there was a break of structure here. Markets put down, made like this inducement which did not mitigate my breaker. So I used my breaker as my entry. Now, how do I pick my take profit? If you pay attention, before market approached my entry, it was making a significant view of higher highs and higher lows, higher highs and higher lows, higher highs and higher lows. And what did I say? If market is making a series of higher highs and higher lows, higher highs and higher lows, there's liquidity being built on the upside. And before knowing that I'm looking for buys on this trade, it means that if eventually market goes to my point of interest for my buy and I'm taking my buy entry, my take profit level should target clearing the entire liquidity on that zone. That was why when price cleared this liquidity, immediately it cleared the liquidity, started reversing. Why? Because liquidity is what fuels the market. Liquidity is what moves the market. So this is an example of market approaching an entry with a downtrend line. And once market is making a downtrend line, series of lower highs and lower lows, lower highs and lower lows, just know that there's liquidity laying above that zone. This normally happens when they want to trigger an entry that's supposed to push market to the opposite direction. And once that happens, your TP level should be to clear the entire trend line liquidity there. That was what I targeted exactly. And once price took out that trend line liquidity, it started reversing. Understand? I will look for another example of market doing that with for sales. And for sales, for example, for sales. Okay, this is a sell trade. So this is our point of interest, say, which is our order block. Then this is our inducement right here for the trade. It's our inducement. This is our inducement. This is our order block for the trade. So when market was approaching this point of interest, it was making a series of higher highs and higher lows. This is an uptrend, okay? But if you pay attention, market is originally on a downtrend. And now, knowing that this uptrend is just for me to go and trigger my point of interest, what's happening? Market is making a series of higher highs and higher lows, higher highs and higher lows, higher highs and higher lows. So clearly, you know that this is an uptrend. And when market is making a series of higher highs and higher lows, there's liquidity being built on the downside of the market. Now, what I'm targeting for is a price to trigger my point of interest here. And because I pay attention to the manner in which market is approaching my point of interest, my take profit, my initial take profit, by the way, should be here, targeting the trend line liquidity on this side. So knowing your liquidity, your types of liquidity will help you in knowing where to take profits on a trade. Now, if you don't understand that market is actually going to clear this entire trend line liquidity, most people will be looking for buys here on this trade. Most people will be looking for buys here on this trade, saying, hey, there's a break of structure, there's an engagement, and then there's another block. Most people will be looking for buys on this trade here. What will happen? They will be taking out because market's already reacting from a sell order block. And at the same time, for it to TP, it has to clear the entire trend line liquidity on this side. So most people do send me their charts and be like, oh, what happened? They have their break of structure, they have their inducement, and they have their other block, but markets ended up taking them out anyway. And they will mark out and be like, this is a trend line liquidity. I don't blame them because I've not yet taught types of liquidity. But because I'm teaching it now, so before you take your entry, make sure that price is not reacting from an opposite direction point of interest, number one. Number two, you now ensure that you're not taking a trade off of a liquidity zone. This is clearly trendline liquidity because market is making a series of higher highs and higher lows while approaching this overall trend of the market, which is market being bearish, because we can see our structure shift here. You can see our first pullback, which is the inducement. And then we can see our other block, which is our point of interest. Now, the manner in which market approached our point of interest is the uptrend line liquidity. So what's going to be my take profit now? My take profit is going to be that trend line liquidity. So until that trend line liquidity gets swept, I'm not going to be looking for any buys on this trade because there is liquidity here. And liquidity is what fuels the market. Once one point of liquidity has been taken, market moves on to take out the other point of liquidity. So now that this buy side liquidity has been taken for this side, market clear this inducement and trigger this other block. My take profit has to be this trend line liquidity to be cleared. And if this trend line liquidity does not get cleared, I'm not going to be looking for a trade on the opposite direction. That's what most people don't understand. Same as this. This is an uptrend, higher highs and higher lows. This one is a bit short, but this trend line liquidity. And before I can start looking for any trade here, I have to make sure that this trend line liquidity gets swept. And immediately after price sweeps it, that's when I can now start looking for another trade in the opposite direction. Pay attention here. This is another block here for GBP This is an inducement here for GBP Now, before price approached our point of interest, it was making a series of higher highs and higher lows, higher highs and higher lows, higher highs and higher lows, higher highs. Then this was when it approached our point of interest. Now, knowing the pattern that was being formed, why our point of interest was getting approached, it is an uptrend line pattern. That is, trend line liquidity is laying down here. So if you start taking your trade, for you to take your take profit, you have to make sure that this entire trend line liquidity gets swept first. So if you take your trade, your sell setup here, your take profit should target entire trend line liquidity right here. So if you put your stop loss here, your TP should target the entire trend line liquidity right here. This trade is the 1:9.7 risk to reward ratio. If you're risking $100 on this trade, you'll be making $970. If you're risking $20, you'll be making $1,800 and something dollars with just one single setup and understanding market structure, understanding liquidity, and understanding point of interest. Now, most people now will end up looking for trades here, taking a buy here because they see another block. You get stumped out. Why? Because there's still liquidity to be taken out on this side, and once liquidity has not yet been taken out, any trade targeting the opposite direction is going to fail. Most people still look for trades on this zone because they see an order block, they see a break of structure, they see inducement, they think it's valid. It's not valid because the market already triggered a reversal on the opposite direction, and at the same time, price has not yet hit TP. How do I know that price is not yet hit TP? Because this is an uptrend, and once market is making a series of higher highs and higher lows, there's liquidity being accumulated on the sell side. And once price triggers the main point of interest for reversal, that trend line liquidity has to be swept first. That is it on trend line liquidity for the uptrend and the downtrend. I'll move into equal highs and equal lows liquidity. Can you all see my screen? If you can see my screen, just comment thumbs up on the thing. You can see my screen, right? Okay, okay, okay. So now I've talked about trend line liquidity, uptrend line liquidity, and downtrend line liquidity. Once you understand those patterns, higher highs and higher lows, higher highs and higher lows, that's what an uptrend is. If market eventually shifts structure to start going to the opposite direction, that trend line liquidity has to be swept before markets can eventually start looking for an opposite trade. That trend line liquidity has to be swept. Now I want to go to equal highs and equal lows liquidity. What do I mean by equal highs and equal lows liquidity? This is what I mean. When market makes an equal high or an equal low, there's liquidity laying on that high for when market makes an equal high. And for when market makes an equal low, there's liquidity laying on that low. I'm trying to see an example for the previous trade I've taken. So I can better show you guys what I mean. Now, exactly, right here. Pay attention to this trade. There are actually two types of liquidity that formed here for this particular trade. For the first one, market was making a series of higher highs and higher lows here for this particular trade, and this was where the trend started right here. Understand? Eventually, when price started reversing from this zone, what the price started clearing those trend line liquidities, cleared this first one, cleared the second one, cleared the third one until it got to the place that market started the trend from. After it got to this place and swept it, what the market do started pulling back up. And while it was pulling back up, we do understand that we're looking for sales because pay attention, there was a market structure shift here. There's an inducement here and there's an order block here. So we're looking for sales, right? But when market is approaching our point of interest, which is this sell order block, the market was approaching it. What was it doing? It was making a series of higher highs and higher lows. That is higher highs and higher lows while approaching our point of interest. What does that tell us? The market is creating trend line liquidity on this downside, higher highs and higher lows, higher highs and higher lows. So trend line liquidity was being created here. At the same time, price was approaching our entry for sales here. So if I'm taking this trade, where should my overall take profit be? My overall take profit should be the start of this trend line right here. And what the price do? I took my TP from this equal low, but I want to give an example with the trend line liquidity first. If you're targeting full TP, I just got the trade and I left. But if you're targeting full TP, this is the beginning of the trend line liquidity because this was where it started making a series of higher highs and higher lows, higher highs and higher lows, higher highs and higher lows, while approaching our sell. So now we have to first identify the trend of the market. Yes, we're looking for sales on this trade. So any other buy that you're looking for should be ignored. So we know we're looking for sales. Okay, we've gotten that in line that we're looking for sales because market just shifts, inducement and other block. We're looking for sales. Where should our take profit be? We now pay attention to the pattern in which markets are approaching our point of interest. So what's the pattern? Uptrend line liquidity. Higher highs, higher lows. higher highs, higher lows. So what does that tell us? It means if markets eventually starts reversing to the downside, it's going to clear this entire trend line. This trend line liquidity. So this is your target and what the price do. Before price made any kind of continuation, it cleared this entire trend line liquidity. That should be your first. And after clearing the trend line liquidity, that was when we now started seeing markets preparing for buys and eventually buying more. But if you are looking to take your trade, a buy from this zone, for example, you'll be taken out eventually because it's not going to be a long-term buy. Taken out, you're looking to take from this other block, will be taken out. Why? Because market has not yet cleared liquidity. Now I want to show you another example of where you could have also taken your profits if you didn't want to, if you don't want to like take this kind of risk of holding the trade for this long. If you pay attention here, see an equal bottom right here, an equal low that markets made right here. This is an equal low. So what did I say equal low is? Equal low is actually a type of liquidity. It's a sell side liquidity, equal lows. So that was what market made here, equal low. So there's liquidity laying down here. Equal lows liquidity laying down here. So as I took my buy, I could easily place my TP on this equal low, knowing damn well that is for this second sell. I'm talking about this second sell that's triggered from this other block right here. This sell here that triggered from this other block. My TP would be this equal low right here, because what do I know? When market makes an equal low, there's definitely liquidity laying on that low, and eventually it will get taken out. If the liquidity is not taken out, market is not moving anywhere. Even if it makes any move, it's going to be temporarily, just to trigger a point of interest that will continue markets going in that direction to clear that liquidity. Liquidity is what fuels the market. Once liquidity is taken from this side, it's heading to the other side to take out liquidity. That's why people ask me, why do I have confidence staying in trade for so long? Because I know that liquidity has not yet been taken out. And there's not going to be enough momentum for markets to reverse to one side without liquidity being taken out on this side, except I make a mistake in picking my zones. But as long as I'm correct with my liquidity, as long as the market has taken out liquidity on this side, it has to take out liquidity on the other side. That is what fuels the market from point A to point B, from point B to point A. That's how the market moves. It has a direction, it has a specific place it moves. Understanding how the market moves, that's liquidity is what actually moves the market. Liquidity is money. It's liquid, it's money. That's what it means. Market is going to where money is. I'll go here, I'll pick up money from this side. And before I can go to the other side, I have to pick up money from the other side. That is what liquidity. You understand? That's what liquid. Some people saying that they don't have liquid cash. They be liquid, that's what it is in the market, having money. So equal lows is another type of liquidity. That's what I marked out here. So when I saw this equal lows on this side, I knew there was liquidity laying on this downside. So if I was taking a sell from this zone, my take profit should target this equal lows liquidity. Another type of liquidity is equal highs liquidity. That's when market does something like this. That's when market does something like this. This is what an equal high is. This. Market does something like this, just know there's liquidity laying on this top side. And if market eventually starts buying from this zone, your take profit should target clearing that liquidity on the high side, because market made an equal high there. So equal lows liquidity, equal highs liquidity, downtrend line liquidity, uptrend line liquidity. The pattern in which markets behaves before approaching your point of interest should tell you where your take profit should be. So if market is approaching your point of interest and it makes an uptrend liquidity before approaching that point of interest, if it triggers your point of interest, your take profit should target the next draw on liquidity. That's clearing that trend line liquidity. If market is approaching your buy order block or breaker block or your buy point of interest and is making a series of lower highs and lower lows while approaching that entry, if it triggers that entry, the take profit should target the next draw on liquidity on the buy side, which is clearing that trend line liquidity that it was making while approaching an entry. If market is approaching your entry for a buy and then it made an equal high liquidity and it's approaching your entry for a buy, if you take that entry for a buy, your take profit should target the equal high liquidity. If your entry is approaching for a sell and you made an equal lows liquidity, if you take your entry for the sell, your take profit should target the equal lows liquidity. Now, there are other factors that I use for my take profits. That is using reversal using point of interest to exit my trades. For example, if I take a trade for a buy and I'm taking the buy and I see a point of interest that fits all the rules. I have 4 rules on picking a point of interest. Number one, it has to trigger a break of structure. Number two, it has to have inducement or liquidity. Number three, it has to be unmitigated. Number four, it needs to be the closest one to liquidity. If, for example, I'm taking a buy and my take profit and I now see another block that has all those qualities on the upside, for example, they say this is the other block with all those qualities. And this other block actually triggered a break of structure. This other block has liquidity. This other block is unmitigated, and this other block is closest to liquidity. And I'm taking a buy from this zone, for example. My take profit should actually be close to this other block because I'm suspecting that market will eventually come to this other block and actually trigger a sell for me. It's the same thing that happened here. This market was buying from this zone. But if you pay attention here, this is another block, and this other block is valid because it has an inducement here. It's actually triggered a shift in market structure. So the person that was taking a buy here, their take profit should actually be close to this other block right here. So for your take profits, you can actually use point of interest as your take profit, but it has to be a valid point of interest. If you analyze a trade and you see another block, because you analyze a trade for a buy, the take profit should be as if you analyze the sell. If you are to take a sell on this trade, would you take a sell from this other block? That's what you ask yourself. If you're taking a buy here, for you to take your take profit, you ask yourself, yes, I can see another block here. But if I came into the market and I'm trying to take a sell on this particular market, would I take a trade from this other block? Is it valid for this market to trigger a reversal for me? If the answer is no, that it does not fit all your rules, then there's no point taking your profit on that other block because on a normal day, that other block cannot trigger a reversal in the market. But if you check, can this other block actually trigger a reversal in the market? And does the other block have a break of structure or does it have a market structure shift? If yes, does it have liquidity? Yes. Is this unmitigated? Yes. And then you take your trade. That other block, you should be looking at taking your profit before market gets to that other block because there's a high chance that market will reverse once it gets to that other block. Same thing as having a breaker block. Once it's a point of interest and it's a valid point of interest, and you're taking the trade to the opposite direction that heads to that point of interest, and that point of interest is valid for reversal, take your profit before market gets to that point of interest. Another type of liquidity is I use long wicks. Long wicks liquidity, something like this. Long wicks. There was a trade I analyzed. Long wick liquidity. Yeah, this is a long wick. So I use that as my liquidity. But market made this shift in market structure here, has this inducement right here, and then made this long wick. I monitor to see, okay, this long wick is liquidity. And before market can actually move, if market actually starts selling, it actually come out and take out this long wick liquidity right here. And then I think I have the play out of the trade. See if I can find the play out of the trade. It's on the 15 minutes time frame. Yeah. What's wrong, man? Let's go. This was the trade. So I analyzed this trade and also pay attention. Market was approaching this my sell order block. What was it doing? It was making a series of lower highs and lower lows. That is, it started from here actually. Lower highs, higher highs, higher lows, higher highs, higher lows, higher highs. So you could have also as well taken your profits here. Understand? But me, I paid attention to the market and I realized that this is a long week, and this long week is liquidity. So this is also a long week, but this is also a start of a trend line, an uptrend line liquidity. So you can take your profit here At the same time, you can also take your profit here. That's why in market there's the TP1, that's TP2. So for me, taking this trade, I will mark this beginning of this uptrend line liquidity as my TP1. And I'll mark this external long wick as my TP2. So like I said, there are different types of liquidity. The equal lows liquidity, that is double bottom liquidity. Equal highs liquidity, that is double top. When it's equal, that's the uptrend line liquidity, the downtrend line liquidity, there's the long wick liquidity. And if you're taking your profit, you can use those levels to take your profit, or can also use valid point of interest to take your profit. You understand? Class is not supposed to be long. It's just this is what I have to talk about. So if you have questions on this, you can ask me. There's no laws of the liquidity trends. If you have any question on this, just ask me. Okay, CJ, what's your question? CJ, so you have the question.
Good evening, boss. Good
Yeah,
evening,
good
everyone.
evening. Yeah, good evening.
Um,
What's your question?
yeah. For this trade, I have a question for two trades still on GJ2. On this very chart now,
Yeah.
this yeah, no, yeah, this the TP you just took triggered a buy entry also.
Which one?
The last trade you just showed us
Okay.
before.
Wait, see this trade. So
Yeah, exactly. Yeah,
yeah,
yeah, the liquidity you took for your TP, I think to me is an inducement for a buy trade, which got
yeah. It's an inducement for a buy trade.
the buy trade seems valid to me. I don't know if it's valid to you to start with.
Yeah, it's valid now. This is market was initially on a downtrend, as you can see here. Market was making a series of lower highs and lower lows, lower highs and lower lows. Then all of a sudden, this shifted structure upside. After shifting structure, made this pullback that mitigated this breaker. So this is the inducement. After everything the market did, eventually came swept that inducement and triggered this other block right here. That was where the buy continuation started.
Thank you very much. And then my other question was about the sweep for the sweep. You took, I think you took a sell. mm,
Yeah.
Then you had a second entry. That was the first example you made from GJ. The second entry just triggered another block. So my question is, if maybe we have a POI, then while the POI was moving, it had another block, and then maybe price just went half of our TP. Can we still enter the trade for a second entry with just the other block
Yes,
without
you
an
can.
inducement?
Yeah, you can.
Okay.
You can because I think but thing is there's going to be an inducement on lower time frames actually. Usually times when a trade is in progress, I actually scaled down to lower time frames to get more entries. There was a trade I took on GJ that I used two entries on. Let me see if I can find it. It triggered my breaker block. It was going well. I had to enter extra positions, but the entry I took was also from another breaker. But those depends on the time frame you're actually looking at. When price breaks out or does anything, if you have to, it's very fast because the main point of interest has already triggered. So there's going to be an impulsive move in the market. For example, if you're looking for buys, before market comes to the buy entry, there are not going to be a lot of buyers in that market. The buyers will just be coming in a bit to pull in a pull. But once that main point of interest, the institutional orders have been triggered at the other block or the breaker block. Once that has happened, market is reversing. It's going to reverse with so much momentum that you can't really catch the retest on the higher time frame. So once this is happening, you want to look for another entry. and it's happening so fast, you have to scale down to lower time frames. You would actually see inducements on those time frames actually. You understand? You understand? Yeah. My risk management and money management secrets. How do I use big loss on small accounts? I want you to stay together before it goes daily. Okay. See, let me talk about this. Before you have capital to trade, stand. You need to draw out your plan. I don't trade anything without a trading plan, actually. Any amount of money that I fund to trade with, I have a trading plan for it. If it does not work, I'll try again. I'll have calculation for $100,000 capital. I have calculations for $10,000 capital. I have calculations for $800 trading capital. Why is this important? It makes you not just trade for trading's sake. It makes you trade with a goal. Now, this is what I do. If my risk, I used to have a fixed risk, not fixed risk to reward ratio, fixed risk. Understand? Like the amount of money I risk per trade used to be $100. You understand? So, if, for example, I take this trade now, let's say I take one trade here, which let me find one trade. This trade is a 1:, actually here. So my TP. This trade is a 1:6 risk to reward ratio. If I was risking $100 on this trade, I would be making 600 and something dollars. And after that, if I was risking $100 on this trade, I'll be making $900. So my $100 account that I'm risking everything in, because as I wait to calculate and know the loss size to use depending on your stop loss. So let's say, for example, this is how many pip stop loss. This is 15 pip stop loss. If I'm $100 on this trade, my lot size will be one lot size, because that's how you calculate GJ. I made a video on how to calculate this depending on the stop loss. So GJ calculation unit is 6.65. That's in dollars. So for example, if I'm risking $100, I will do $100 divided by 6.65. It will give you around 15 point something. Now do that 15 point something that I gave you divided by the amount in pips of the stop loss. So this is about 15 pips stop loss, 14.9, but 15 pips. 15 divided by 15 is 1. That means you're going to use one loss size on this trade. That if your stop loss should hit, you're going to lose just $100. Now, that same way, this is a 1:9.7 risk to reward ratio trade. So using that one lot size, if you take your trade from this zone and TP hits, you're going to be making $970. You have easily grown $100 capital to a $1,000 trading capital. Now, having a fixed risk for me is better now, because for me to lose back that profit that I made on that one single trade, I have to lose 9 consecutive trades. This was before I grew my trading capital. So having $100 trading capital, and I take a trade and it gives me a 1:9 risk to reward ratio, and I have, plus my capital and the profit I made, and I have $1,000 to trade with. Having a fixed risk now of risking $100 per trade will now make me, the next trade I would take, I'll risk $100. If I lose, I still have $900 to trade with. I'll find another trade. I trade just 3 times in a week, 3 days in a week. So let's say I find one trade and I take a loss for this week. I still have $900. The next day, I take another loss. My fixed risk, I still have another $800. I take another trade, I lose. I still have $700. By next week, I can catch another trade that will do 1:5 or 1:6. I've made $600. I've covered up $300 loss with an extra $300 profit. My account is at $1,300 profit. I'll have another fixed risk of $100. I'll take another trade. I'm going to now lose back what I've made in just 2 trades. I have to take a consecutive 13 losses. I think around 13 losses. For you to take 13 losses consecutively, either you are just playing around or they are not really taking trading things serious. Even if you have consecutive back-to-back losses 10 times, you're not going to lose back what you make on a single trade and a half. That is how you do money management and risk management. Not by small loss sizes, by preconceiving your risk. Before you enter a trade, you preconceive what you're going to risk. Get the loss size applicable for that amount of money you funded with your stop loss. Get your risk to reward. Most people will take a trade here and their stop loss will be here. Where are you shooting your stop loss to? You're getting your entry with a specific candle and other block. Your stop loss should just be enough to cover up that other block, limiting you with a smaller stop loss. Your stop loss targets where you get your entry from. If you get your entry from an other block, There's no way shifting your stop loss to 30 pips. Why? That's not where you go to entry from, except you're not sure of what you analyzed. If your entry is from a breakup block, your stop loss should just be below that breakup block. If your entry is from another block, your stop loss should just be veered away from that handle that you got your entry from. Can give you a few 2 or 3 pips because of spread. Now with that, it gives you a higher risk to reward ratio, risking a minimum amount of money. There was a trade I took on gold. The trade I took on gold, I made $2,000 on. Okay, I don't want to use this. The trade I took on gold that I made $2,000 on. This trade. Now, if I have a fixed risk of, this is basically $100 deposit. If I have a fixed risk of risking only, that was why I was depositing $100 to do this. If I have a fixed risk of risking only $100 per trade, and this my single win is $2,000 actually. So it would take me losing 20 times to lose back a profit I make on a single trade. That is money management. And before I can even lose 20 times, I can actually win 2 more times. That will increase my risk. For me to lose back a profit I make on a single trade or in 3, I have to lose 30, 60 times. Do you understand the difference? Now, you now have an advantage towards the market that you can have a losing streak and still not be drawdown. Having money management, having a fixed risk, number one. I didn't say a fixed risk to reward. I said a fixed risk. Your reward depends on the setup. Market can give you 1:3 today, give you 1:5 tomorrow, give you 1:30 today. I got a trade with 1:30 risk to reward ratio. I don't do that every day. The rate is 1:6 or 1:7. If I risk $100, I'm getting $700. And as the way I analyze trades, why trades is going, I can take a trade from another block, and eventually the market will break structure, give me an inducement, and then I'll get a second entry. Take my second entry, maximize my profit. A 1:10 risk, a 1:7 risk to reward trade can now eventually turn into 1:20. This gold trade is a 1:20 risk to reward ratio. Initially, it was a 1:6 risk to reward ratio. These other entries were added after market broke structure and then came back to give me a confirmation it's going to go up. That was when I entered more positions. Now, if I stick to risking $100 per trade, it will take me losing 20 consecutive times to lose back what I make on a single trade. Yeah, I hope I have explained this in a way you can understand it. I don't understand what yeah. So that is that on money management and risk management. It's just basically writing down your plan. I don't deposit any amount of money that I've ever deposited. Any amount of money that I've ever deposited, from $100, $200 to $50 to everything. A plan to trade it is always on my phone. The plan to everything is always on my phone. That's if I deposit and I lose, I will try again with the same plan on my phone. Eventually, it's going to work. It was on synthetic pairs, so I've traded synthetic pairs. How do you trade another block that's unmitigated on lower time frames? Use higher time frames. If it's unmitigated on higher time frames, it's unmitigated on lower time frames. How do I calculate stop loss for gold and BTC? Gold and BTC. Okay. BTC. This is what I do for BTC. It's actually quite simple. Let's say I take a trade from here, a buy for my BTC trade here, and my stop loss is that is the trade I took today, and my stop loss is here, for example. My stop loss is here, and then my take profit is here. Understand? From how to calculate the stop loss in pieces, pay attention to this number right here. This number here. This number, it's 8.34. This is your stop loss. So if you want to risk $100 on this trade, what you just do is $100 divided by 8.34. Whatever amount it gives you is what you should use as your lot size. So if I was risking $100 on this trade and I divide it with the stop loss, which is 8.34, this thing is the result that it gives me is 1.13. It means you should use 1.13 lot size. If you use 1.13 lot size and your stop loss should hit, you're losing $100. That's how to calculate stop loss on BTC. You understand? If you want to risk $500 on this trade, you do 500 divided by 8.34. It will give you 5.65. Just round it up. Just give you 5.65. It means you use 5.65 lot size. If that stop loss is to hit, you'll be losing exactly $500. That's how to calculate stop loss on BTC. Then for gold, this is how to calculate stop loss on gold. That's calculate stop loss on gold. That's calculate stop loss on gold. You pay attention to this number right here. You can see gold 2.32. Whatever you see here, you multiply it by 10. So in gold, you say 2.32 times 10 is 23.2. This is how many pips stop loss it is. So like I said, there are units of calculations for each pair. USD pairs like Euro USD, gold, ZAO USD, GP USD, they are 10. So because the stop loss is 23.2 and the calculation unit for gold is 10, if you want to risk $200 on this, or if you want to risk $100 on this, you do 100 divided by the calculation unit of gold is 10. 100 divided by 10, that will give you 10. Then I divide it with this stop loss that is here. 2.32 multiplied by 10 is 23.2. Now do 10 divided by 23.2 is 0.43. It means you should use 0.43 lot size on this trade. If you use 0.43 lot size on this trade and your stop loss hits, you're losing exactly $100. If your TP hits 0.43 times 10 times, you'll be making $860 on this trade. You understand? That's how stop loss stop loss for gold. Why I kept my stop loss on that zone is because I've traded breaker blocks for a lot of times now. And if my trader is actually correct and my analysis is correct and market is going to use breaker block to buy, what's the point of shifting my stop loss too far? Market is going to buy from my breaker block. It's going to buy from my breaker block. It's not going to move on to the next point of interest. If my breaker block is valid, I'm trusting my analysis. My breaker block is valid. There's another block there. That's a breaker block there. I have confidence that market is going to buy with my breaker block. I can be wrong on my analysis, then it means I'm wrong. But me knowing that market is going to buy from my breaker block, my stop loss should just be below my breaker block. I don't have to, even this stop loss that I did is even too much for myself. On a normal day, it's because I sent a friend of mine the setup. On a normal day, my stop loss would be here. Why? Because this is a breaker block. My market is buying from my breaker. It's not going to get to my other block if my analysis is correct. And it was correct. Market bought from my breaker. No drawdown, actually. Just triggered and started moving. There was no point keeping my SL all the way here. Now pay attention. This keeping my SL here makes this trade a 1:3.6 risk to reward ratio. But keeping my stop loss here makes this trade a 1:6 risk to reward ratio. Just by being technically correct. Technical analysis, just being technically correct. I know that since I'm taking this trade from my point of interest, which is my breaker block, market is going to reverse from my breaker block. If price reverses from my breaker block, what's the point of shifting my SL all the way? That you have to be correct with your technical analysis. If I was giving someone else a setup, I would keep my SL here for them to just be safe. But me taking the risk on my own, I trust my setup. I know that market did not mitigate this breaker block after it shifted structure, and the point of interest is going to use is this breaker. Since market, I'm not going to expect market to come down to my other block. There's no point keeping my stop loss there. That's just it. It works on. I don't do live trades with anybody. In fact, I've not been trading much recently. I just come out, look at my laptop. If I see something, I just take it. This analysis was done on that 3 minutes. I didn't have I can't make a trading plan for you. You have to be the one to make a trading plan depending on the amount of money you have and what feels well for you. And why I open many positions? I don't open many positions. I start with the initial risk I want to take for that particular trade. So if, for example, I'm risking $100 and my lot size I'm supposed to use is one lot size, I start with my one lot size. But when something like this happens, market breaking structure, retesting to this OB, that's when I add more positions because I know the market is giving me a confirmation that this trade is more valid now. Because while the market keeps making a move, I keep analyzing. Yes, my initial point of interest is this, but that didn't stop market from also making a pullback here and also making a pullback here. So I can enter my first positions here, and market makes this equal shift of structure and then make this here, and I can add another position here, knowing that this is giving me more confluence that price is going in my direction. I just want to add another position. Then after market breaks another high and retest, add another position. There were unplanned trades. If market doesn't give me kind of information, I won't enter. I'll just leave my initial in there. But once market gives me, because I keep analyzing why the trade is ongoing, so I can find more entries. While market keeps giving me, I tend to maximize my wins. Yes, I'm still going to be risking the same amount of money. It's going to still be $100 risk. But if my initial profit was $500, I stand to make $2,000 on this trade now. If my initial profit was $3,000, I stand to make $7,000 on this trade just by analyzing why the trade is going on and finding a way to add extra positions to my trade. I don't understand anything. Why am I backtesting a clean chart? Why did that target on this gold you showed us recently? Gold, which gold? This one. I targeted this. Actually, it was this other block for reversal. So I saw no. This trade, I knew the market gold was going to take out this high. How did I know? Because market actually made this was a trend line liquidity, lower highs and lower. Eventually, would clear this trend line liquidity. After clearing this trend line liquidity, there was nothing else for gold to do because there's nothing else that can hold gold on for like to sell again. So my target was actually just this other block here. Sha. There was nothing too intense, just this other block. This is why I knew that market will actually start reversing. This was my target on gold, just this other block. If market will reverse, it will reverse from this other block. That was my target for gold, actually. It works on synthetics. Time frames, I use any time frame and I take my analysis, I look for a point of interest on that time frame. If I don't see the point of interest on that time frame, I keep switching time frames that I find my point of interest that I'm looking for. I don't put any stop loss. I know what I'm risking. I do this, I'm still going to risk the same amount of money. That's just it. I do this when I deposit the amount of money that I want to risk. So if the trade should go against, I'm still going to lose what I intended to lose in the first place. This is I just do this sometimes. If I'm trading a capital for like let's say $20,000 or $50,000, and I'm risking like 5K, for example, I'm not going to do this because 5K profit is that 5K risk. If I'm targeting a 1:5 risk to reward ratio, that's about $25,000 profit. Is enough money to be okay in a single trade. So I won't try to maximize my profit. I'll just leave everything to them. But when I'm risking a minimum amount, for example, I don't really plan on trading and I just deposit $100. I don't care if I lose $100. I don't care if I lose $200. I don't even care if I lose 1K. If market moves and gives me more confirmation, I can take a trade. If I lose the trade, I know that that was what I intended to lose. But if I'm trading a large capital of 50K, 20K, that can fuck up my trading account because if that eventually goes against me, it's going to incur more loss on the account that I planned. Except I deposited my risk to the trading account. Like what I want to risk is what I deposited. That's when I do this kind of thing. So this is going to be the end of this class. This particular class is going to be ended. The market is about to open very soon. So whatever I taught you, and you back test, you watch the video, you back test, you forward test, asking you questions after you've taken a trade on the setup and the plays out, not before. So I'm going to save the recording for this class and I'm going to send it to the Telegram channel. That's going to be the end of this session. Basically covered almost everything in the class. Next class I will have just to summarize everything together. Start from market structure. There's going to be a summary. Market structure, inducement, point of interest, and then this take profit level. That's just this. That's just the end of this class. Yeah.